Next up, as you can see, is Mark Baribeau, Head of Global Equity at Jennison. He has been a long-term manager in our Global Equity Fund and is now running the recently launched Curate Global Growth Fund. As Mark would say, I'm almost sure, over the long run, you are your record. Since we appointed Mark and team coming up to 13 years ago, their strategy has outperformed the global equity market. Remember that thing that no one beats? They've outperformed that by 5.1% per annum and the global growth index by 3.3% per annum. Not bad. Ladies and gentlemen, Mark Baribeau.
I know today we're going to cover a few topics, but the focus of it would be on AI just because of the structure of your think tank this year in terms of looking at this big structural shifts going on. There's a lot going on in our portfolio. We should cover that, do a quick review, but I'm going to spend most of the time talking about what's happening with AI. Sorry, you have a technical difficulty. Is that better? You can use all the JP Morgan disclosures for us too, so I can skip that. So we're going to talk about the fourth era of computing, but before we do that, just some quick, background on what's happening on the markets this year and in our portfolio, because it is very, very concentrated out there in terms of where performance is coming from. Year to date, leadership really hasn't changed that much in global markets. It's evolving now as we speak in the third quarter, kind of going into the fall. You are seeing a little bit of shift, but basically it's been dominated by the Magnificent Seven. They've accounted for 31% of the global stock market return this year. That's actually down from almost half last year. So it is dwindling in impact, but it's still huge. For us, it's 63% of our outperformance this year is due to this cluster of companies. And importantly, NVIDIA accounts for 1/5 of the entire market return this year globally. And for us, it's about half of the alpha. So it's a significant contributor. And so we're going to talk about what's going on in the financial markets as it relates to this boom in generative AI, because it is really important. As a backdrop in our portfolio, we do have several areas of focus. We have this infrastructure build out for generative AI. That's probably the most important driver of return this year. But it's going to have second derivative impacts as we go forward. We'll talk about that. Secondly, we still have a big focus on these strong consumer brands globally that have direct-to-consumer distribution models. That means they control the inventory, they control the final sale to the customer, and so they can control margins, pricing, and general product evolution and dynamism. That kind of competitive advantage in today's global marketplace is really necessary to significantly outperform. So we're definitely still focusing on those types of consumer models, and that could be everything from Ferrari as a product to Mercado Libre as a e-commerce platform in Latin America. Thirdly, we're getting this industrial automation boom. A lot of it focused in the United States, ironically. It's not a global phenomenon, but it's being driven by the move to electrification, data center build-outs for AI, in general electrification related to EVs, and of course the U.S. CHIPS Act, which is stimulating manufacturing for semiconductors in the United States as part of this big move to reshore supply chains away from Asia. So there's investment opportunity here. It's pretty narrow. It's all leading edge, but it is part of the portfolio strategy. Then you have healthcare innovation and treatment for diabetes and obesity. I mean, this is the biggest drug cycles of all time. We're talking tens and tens of billions of dollars of revenue going to two companies, Novo Nordisk and Eli Lilly. And so it's quite an enormous draw of consumer dollars going into these drugs. So we're taking advantage of that also in other areas of rare diseases. And then emerging markets platforms, technology and internet platforms for financial services and e-commerce. Those continue to do exceptionally well, particularly in Latin America, where you're getting a boom in fintech revolution. You're absolutely democratizing access to financial services at low fee to millions and millions of customers, and they're flocking to these platforms. It's pretty exciting. And then lastly, one of the new additions to the portfolio in terms of where we're tilting, the Fed is on the verge of cutting rates by at any minute now, and we're going to start an easing cycle. Long-term interest rates have already come down in anticipation of this. We're going to see more interest rate reductions over the next 6 to 12 months. That's going to help the one part of the economy in the U.S. that's structurally has massive pent-up demand, and that's housing. The millennials are hit their peak household formation years. They're bigger than the baby boom, and there's no housing. And so it's going to trigger, we think, a multi-year build of units in the U.S. It's going to lead to a dramatically enhanced or increased mortgage availability and demand. And so we're taking advantage of that in the portfolio because we think it's going to be a structural winner for the next few years. So that's sort of an overall overarching nature of our portfolio where we're focused today. But as we said, we're going to focus more on Gen AI for this audience today, as just like what's going on. This is it's a big land grab. It's a gold rush. Anything you want to call it. There's hundreds of billions of dollars being bet on this, and so we have to get it right if we're going to be successful. It has enormous impact on everything we do in life. But it's going to happen one step at a time. And the first step is sort of here on the left side of the page is just the build out, the compute power. So when we think about Gen AI, why is it interesting? It actually creates its own new content, new video, new software code. It's thinking like a human mind. It's not like machine learning or traditional AI, which was very linear, very instructive, with constraints on that construction. So you're actually in a phase of content creation, which is very powerful. It's also going to start to take away market share in traditional search, internet search, like Google search, as you use things like ChatGPT to do information search that's different, less structured, and more creative. And so this is a giant transformation in technology, and the infrastructure out there isn't ready for it. So when you see what's happened so far, we've already had billions of dollars spent. So the spending is accelerating. It's just the beginning. And then we expect sort of this end user, the application software, the end user, that's where we expect to see the next iterative product and service sweep for the next 3 to 5 years that's going to be really important from an investment perspective to be on top of. So let's go through the pieces. First, ChatGPT took 2 months to get to 100 million users. That's one of the fastest, if not the fastest, application in history. Took TikTok 9 months. It took Instagram 30 months, etc. Uber 70 months. So this is really fast adoption. So consumers are very into this in terms of testing it, figuring out what it can do for them. Businesses are also equally doing the same thing. The revenue being generated from these apps, sort of the dark green is Gen AI search, the apps are the lighter green. It's in the single-digit billions this year in terms of the revenue just derived from the app. As you can see, it's projected to grow fairly dramatically over the next, 5 to 7 years. So we're talking a big industry pretty quickly. And that's all going to come at the expense of somebody else that's doing this kind of search, this type of application. So there's going to be losers as well. The foundational aspect of AI so far has been pretty clear. On the far left side of this page, you have to build the compute layer because these large language models that generate this type of artificial intelligence require enormous compute power, enormous as in something we've never seen before. So first you have to, you have semiconductor equipment like ASML, you have very complex design for advanced semiconductors for accelerated computing chips. That software comes from Cadence. Then you have, of course, the big guns who are making the chips like TSMC, and then, of course, the prima donnas of the group, NVIDIA, that design the semiconductors and are collecting 75% of the gross profit. Okay, so that's the food chain. Who's buying NVIDIA's GPUs? 48% of it is going to hyperscalers like Microsoft Azure, Google Cloud, Amazon's AWS, Meta as another hyperscaler. You could put Tesla and Apple in that bucket too. That's 48% of the demand. The rest is coming from large enterprises. So it's very concentrated demand. So you can, so far it's been a good way to invest in AI, has not just been on the far left in terms of the supply chain, but also in the cloud-based compute platforms. The CEO of NVIDIA this last week was asked about return on investment for AI, and because it's a big hot topic in the industry now, is this for real, or are we going to make money on this, or is this a lot of money spent for nothing? And he said for every dollar that one of these hyperscalers gives to NVIDIA, it generates $5 of revenue for them on their cloud platform. So that's a big ROI. That's why you're seeing a boom in CapEx. On the software applications, we haven't seen much yet. Everyone's played with ChatGPT, that's great, but we haven't seen anything material. Microsoft Copilot is not that great yet. They're trying to monetize it. They need to improve it. ServiceNow, another big holding of ours, is starting to monetize applications for business process internally in businesses. It's just a process application layer that accelerates and reduce costs, reduce labor hours required to do certain tasks. That's already being monetized. So there's one. And then Apple, of course, has pivoted their entire franchise to Gen AI now because they want to turn your iPhone into your personal assistant using Gen AI. And they're partnering with OpenAI, which owns ChatGPT. So it's a pretty powerful combination. So so far, you're getting a little bit of activity here on the far right, but nothing to write home about. We'll see how it develops. What does the fourth era of computing mean? Well, the biggest impact is in semiconductors. You can see the evolution of the semiconductor industry over time. We just came off the mobile internet, and that's the sort of the orange section here. We're entering the blue. So by 2030, the chip industry will be $1 trillion industry globally. But all the incremental growth is going to be in AI, and it's already started. You're getting a CapEx boom in cloud-based computing. You can see it dipped a little in 2023. That's the hangover from the pandemic. Remember, they spent like crazy to boost cloud computing. We all needed it. Working from home, trying to keep our enterprises going. It took a lull, and then it's reaccelerating again. But and you can see, by the way, on this bar chart, it's hard to read, but those bottom four numbers are four companies. That's the only ones that matter. It's Google, Amazon, Microsoft, and Meta. They are almost 90% of all data center CapEx. So kind of everyone else doesn't really matter. But under the hood, there's a massive transformation. They're not spending on traditional data center. They're expending on accelerated computing. The best example of that is NVIDIA. This has never happened before in the history of mankind. In 2023, NVIDIA did $15 billion of revenue in the data center part of their business. It was a little under half their revenue. Last year, they did $48 billion. This year, they're going to do $110 billion. Their gross margins are 76%. Their operating margin is in the mid-60s. So think of 2/3 of that $110 billion is just dropping right to the bottom line, right to you as a shareholder. It's enormously profitable. So we've never seen in stock market history a company go from 15 billion in revenue to 110 billion in revenue in 2 years. It's not happened. So they're in the lead position. Their GPUs are necessary for accelerated computing, for training large language models and AI. Nobody can replace it. They won. They will have 80 to 85% of this market for the next 3 years. Now the question is, how far is that going to go? The data center installed base is $1 trillion. Over time, the CEO of NVIDIA believes the entire $1 trillion will transition to accelerated computing. So in that previous page where we showed a $220 billion of data center CapEx this year, think about that happening 5 times, but all converting to accelerated computing in the next 3 to 5 years. And in addition, the compute power is a lot bigger than just traditional data centers, so it's likely to be a higher number. It's very hard to model. Obviously, these are huge numbers, and it may not come to fruition because the applications may be slow to develop, like autonomous driving. We've been talking about that with you for how long, and it's still not ready for prime time. That's one of the biggest Gen AI, visionary things out there, but it hasn't happened yet. So we have to be careful about what we're doing in the portfolios because we have a lot of CapEx going in. It's going to a handful of companies. It's coming from a handful of companies. But the one thing we know for sure is the profitability is extraordinarily high in this cluster. So if we look at why is the Magnificent Seven, why is it done so well? Well, here's the S&P 500 EBIT margins for tech and interactive media, that's internet, that's the top line. Over the last 20 years, it's gone up significantly. And then if you take the S&P 500 excluding tech and internet, EBIT margins are the same level they were 35 years ago. They've gone nowhere. In fact, for the average company, that's what you should expect. And so with profitability on a steady march upwardly, because the models are superior, they're scalable, they're global, they're low capital intensity, they're high return on invested capital type business models, you're getting exceptional growth in profits. And there's no reason this is just going to end. Now, somebody might get disrupted by AI, like Google might. So we need to be careful about that. They're not all going to win going forward, but this explains why you've seen the enormous march. The other important element of that profits expansion is it keeps a lid on valuation. So the stocks have done well, but the valuation actually is very reasonable. So here we're looking at what's happened at the prior peak of bubbles in different tech bubbles. So the real spiky hat is the new economy era, peaked in March of 2000. This is relative forward PE ratios, 6 times the market for the tech cluster. The next one down is the mainframe era in 1969, about 3 times the market average at the peak. The current is the little dotted line at the bottom. We're 1.6 times the market average for very good revenue growth and very good profitability. It's not in bubble territory like previous tech booms. So it's a very interesting dilemma in the market. You have this big boom going on. The leaders are driving the boom, but in fact, they're very profitable, generating a lot of free cash flow, so they're not expensive. Very perplexing for the market. It's having a hard time digesting this. Another way to look at this is sales growth. So the current sales growth prior 2 years is on the far right. It's low double-digit growth forecast for the next 2 years. Low double-digit growth, not that much different. Very different than the new economy era or even the pandemic, where in the new economy era you were forecasting 50% growth, and you ended up with 22. So that's why the stocks collapsed. They way missed expectation. You don't have that kind of expectation today. Same thing on valuation for the Magnificent Seven. As we talked about, it's not that demanding. The outside one is Tesla. It is demanding. We sold Tesla in January. As you know, we owned it for over a decade. It was it remains the number 2 contributor to excess return in the portfolio over the last 5 years. But we got rid of it because their margins are coming under pressure. It's very expensive. We don't think they're going to meet consensus expectations. Still forecasted strong growth. However, what we know about big growers, and it's not shown on this chart, but if you go back to 1950 and you look at large companies that grow very quickly in the preceding 5 years, what % live up to expectation in the next 5? It turns out it's about 3 out of 7. So if we use history as a guide, of the Magnificent Seven today as we're standing here, 3 out of the 7 will meet or exceed expectation in the next 5 years. 4 out of the 7 will disappoint and the stocks will do poorly. It's not good odds. So, again, it's been a great place to be, but one by one, you're gonna see them being sold out of the portfolio as we think expectations are too elevated for them. So that's going to be a transition, but that would be normal for history. The other thing is, if we look at CapEx, so the dark line, the peak is IBM at the peak of the mainframe era, accounted for 17% of the entire capital spending in the U.S. market. Not in technology, but all CapEx. Cisco, Lucent, Nortel, at the peak of the internet era, almost 15% of all capital spending in the United States was going to those 3 companies. Data center today is about 8, on its way, according to the consensus, to almost 14% in 2 years. So let's call that the peak. That's pretty much in line with those prior peaks. So, so the sort of summing all this up, what do we think about what's happening at the infrastructure side of developing accelerated computing to power these large language models? We still are in the middle innings of the first part, but we're coming near the end. What's going to be the next phase of growth is going to be in the application layer. And that's going to be in parts of the market that we don't know anything about today. New companies are going to come public with very exciting verticals addressing this. So it's in some large companies are going to develop very cool productivity enhancing applications internally that we'll never see, but they'll be driving down costs. So there's lots of things that are going to happen, but we don't think necessarily it's going to be where the action's been the last couple years. Okay, quick review, and then we'll get into questions. So year to date, up. This is through August. Up 23.4%, excess return of 740 basis points. On top of, it's a really strong year on top of last year, which was a very strong year. What's driving it? Tech, number one, 420 basis points of alpha. Healthcare, 260 basis points of alpha. That's obesity. Okay. Financials, that's all fintech in emerging markets for us. What's quiet this year that's a big focus of ours over the long haul? Consumer. Consumer discretionary, zero. Consumer staples, slightly negative. It's very quiet. It's the one part of the portfolio that over the trailing 1 year has come down in exposure quarter by quarter by quarter as the lagged impact of all of this monetary tightening globally is taking its toll. There are very few companies left standing who are beating numbers in the consumer sector, and we're down to our last few that we're holding on to. Thankfully, we're about to start a new cycle because we're at the end of the misery, and we're about to enter easier monetary policy, lower credit costs. 25, 26 should be pretty good years for consumers. So we're not throwing in the towel. I'm just saying that's where the exposures come down, and that's where the performance has flatlined. Excess return. The big winners are on the left side. NVIDIA, 3.8% of alpha. That's half our alpha for the year. One company. It's up 130% year to date on the backs of those big numbers. But again, our weight has been coming down, and it continues to come down. We're restraining it. We're locking in that excess return because we don't know how sustainable that growth is going into 25, 26. We just don't know. The numbers are too big. The CapEx sensitivity is too high. We have good visit. They're sold out. So it's very difficult to sell a stock of a company that's sold out. And it's not expensive. So we're just managing the risk in the portfolio. We still like it. It's gonna be the big winner long term, but we captured the big discovery phase of the company. The other cluster of AI is Broadcom and accelerated computing chips that are very specific for design purposes, and Arista Networks. All the data traffic controlling these data centers, very, very big for them. And then you see Apple. Okay, the rest is Mercado Libre and Nubank in Latin America, that fintech revolution I talked about. It's booming. And then, of course, Lilly and Novo Nordisk keeping us all skinny. Okay. The other thing about markets is it's been very U.S.-centric for 2 years globally. That's reflected in our developed North America is a big part of our alpha this year. And of course, that's tech and internet. I mean, that's where it's located. Emerging markets also huge. Very quiet in Europe, which again is a big part of our portfolio, but that's where all those big consumer brands are. That's where the direct-to-consumer models are. We love them, but demand has been slowing because of the global economy and because of China. And there's our top 10. So with that, I'll throw it open to questions.
A few slides back, you had your top 10 contributors and then your bottom 10.
Yeah, I never talk about the bottom 10.
How long did you hand them before you actually put them up?
Good question. If it's a great franchise and it's just demand is slowed a little bit because, like Hermes, or Montclair or something like that, demand has not slowed for those two companies. But the valuations come down on fear because it did hit LVMH. That's more aspirational luxury. And so the valuations come down, but in fact, they're not missing numbers. They're still beating numbers. And it's double-digit growth, so we just hang on. We take the pain and hang on. If something is breaking down, as in they're missing numbers and demand is faltering, and there's no visibility to when it improves, we are exiting. So it really depends on what's driving the price performance.
NVIDIA's latest quarterly revenue was, I think, $30 billion. Apple produced 120 in the last full year, but they've got very similar market capitalizations. Can you see NVIDIA going up 3 or 4 times from this level? Not revenue, share price.
Share price. It can certainly double in the next 2 years, but the only way that can happen, well, one, they just have to keep the cadence of beating numbers, which is difficult at this at scale. It's very difficult at this size. And then the market has to, at some point, believe 2026 is going to be a strong double-digit growth year. If the market believes that, the stock can double because it's not expensive. It's mid-20s multiple. It's cheaper than L'Oreal. Okay? It's not. We're not talking, this is not heavy lifting on valuation, but the market, what is the market telling us at that valuation? That it just can't handicap it. The numbers are so big, the growth's been so quick that there has to be some digestion of all this CapEx, and then let it sit for a while, and then it will sitting for a while is not going to be good for the stock. So we have to be careful about that. That's why we've been bringing our position down, but we still own it. You know, but it's tricky. But yeah, it can.
So Tesla's an interesting business model, especially when it comes to AI. If the valuations come down, would you reconsider?
Yeah, we never say no to anything. The problem with Tesla, 2 years ago, their gross margins were 30%. BMWs were 15%. Today, Tesla's gross margins are 17%, on its way to BMW. So they've lost their pricing power. They've had to cut price to move product. And so if I sit back and look at their EV franchise, which is 90% of their revenue, it's just an auto company. And by the way, their revenue growth isn't that great. So AI will have to be the driver to change the narrative. I'm a Tesla driver because we were a big shareholder. I'm a Tesla driver. I also bought full FSD beta, 13 grand, because I needed to track it, and I had to write that check. And on a highway, getting off a highway, getting on a secondary road, it's great, especially when it's not congested. It works, but the minute you throw it into a confusing situation, it's very cautious. It's more cautious than we are. That's why it's safer. But caution doesn't work if you're just sitting there and you can't turn left and everyone's just blowing by you. It doesn't work. So I used to be a big believer in the Tesla software story that this would take off, but in fact, less than 15% of Tesla buyers, which I would argue were product forward people, tech forward people, bought autopilot, and less than 5% buy FSD, full self-driving. So as a consumer product, it's actually not popular. And so until it's popular, there is no autonomous driving story there. I don't believe it. And it may be there isn't really a good consumer use case for it, there's a good commercial use case for it. Like Uber would love to have autonomous driving because they could fire all the drivers who they don't like anyway. And that's a commercial application. But for you and I, we actually don't mind driving. You know, I don't know. The consumer data just doesn't support betting the ranch on a software boom at Tesla. And say nothing about the Elon Musk factor that just gets more and more complicated every hour. So that's our view on that one. We're staying away for now.
Still talking about infrastructure. What is your view on when infrastructure will be regulated?
In the US, there will be none. In the EU, that's already underway. So when ChatGPT first came out, the first thing that happened was every tech company in the US pivoted R&D to Gen AI. How can we win from this? How can we do things with this? And the first thing the EU did was regulate it. So that's the nature of what's happening. So as you bring out services, it's a big question mark. Will Apple, say Apple becomes your personal assistant, will it be deployed in Europe? We don't know. It can't be deployed in China. So, by the way, we haven't talked about this, but China's going to sit out the fourth era of computing. It's going to be devastating to their growth aspirations. And the reason is the government cannot let Gen AI just develop in the private sector as it should, because they can't control it. So it's not going to happen. So they're going to sit it out. I mean, it's going to be autonomous driving for taxis and facial recognition for the government, and that's the end of the AI story in China. It's really bad. So I don't know what's going to happen on the regulatory front. It's going to be very piecemeal around the world. But in the U.S., there's not going to be any regulation for a long time. They're going to let it go until it does something bad, and then that's what they do.